And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday. John Penn joining me this morning, back from his well-earned vacation. So a lot of things to talk about. Of course, big news is Roaring Kitty is back. I was going to wear my red tie this morning, but I threw away all my ties a while back, so I'm going to go buy one just for the show. But the Roaring Kitty is back. If you don't know who that is, Roaring Kitty was a guy that became famous on YouTube back in 2021 because he was touting shares of GameStop and AMC. And this is where the whole Reddit crowd got, onto Reddit talking about to the moon and started seeing all the rocket ships relating to AMC and GameStop. Well, AMC and GameStop back yesterday as Roaring Kitty made his appearance. And that stock was up about 70% yesterday. It's up another 40% this morning-ish. So that whole theme chase, that meme chase, is back at least for the last couple of days, causing hedge funds a good bit of pain. Yesterday, the most shorted basket, which includes those stocks, got hit pretty hard. So again, the hedge funds, Wall Street, took it on the chin yesterday in those two positions. But that's the whole goal of this whole kind of Reddit thing, is to put it to the man, right? We're gonna give it to Wall Street. Just remember this time, guys, to sell, right? Don't forget the sell part. You're doing great on the buy, but don't forget the sell part. A lot of these guys, they were diamond hands. I'm gonna hold it, and you give up all your gains that way. So don't forget to sell some. Take advantage of the gain. It's great. More power to you. But that's just, the insanity is now back in the market. So we've now made a complete round trip in the markets. We're back to 2021. But outside of that, we have Jerome Powell has a speech today. All eyes will be on that speech. A couple of reasons why. He already knows the CPI number that's coming out tomorrow. So look for some clues, or if there are any clues. One thing that may move the market today is if, when he gives that speech later on this afternoon, if there's any hint that there is a hotter than expected inflation print. Does he back off potentially, the reversion of QT, whatever it is? So that'll be the market will be focusing on that speech this afternoon for any details ahead of that CPI report out in the morning. And of course, on Thursday, we've got PPI out. So that's the producer price index. So over the next 2 days, lots of inflation data. Expectations now for CPI are at this moment 0.4. So that's a pretty high read. Normally CPI prints around 0.2, 0.3 historically. So again, a weaker than expected CPI tomorrow would obviously lead to higher asset prices. Markets have been rallying for the last couple of days really in advance of that. But the expectation is for a weaker print in CPI tomorrow, which would further firm up this idea of potential rate cuts this year. Remember, the market was expecting 7 rate cuts. They got down to 1. Now we're back up to 2 rate cuts this year. A weaker print tomorrow might get us back to 3. That's all providing monetary accommodation to the markets. That provides, that gets everybody excited. So we continue to see kind of asset prices kind of creep up here. Outside of that, economic data has been coming in weaker than expected, really kind of across the board. So if you take a look at the Citi Surprise Index, that continues to show some signs of weakness economically. Again, that's also disinflationary, but we are starting to see the impact of that kind of weaker consumer, at least here in the short term. Now, that doesn't necessarily mean recession. It just means the economy may be slowing down. I got an interesting text from a good friend of mine yesterday who owns a lot of restaurants, and he said this is the first time since really the 2020 pandemic that he has his waiters and wait staff, etc., wanting to take food home after work, right? Some of the excess food that's cooked in the restaurant, that they want to take that home, instead of throwing it out. So again, seeing, just some signs that the consumer is starting to slow down because of higher costs, higher prices, et cetera. Again, not surprising. We talked about recently how excess savings are starting to kind of run out. We're starting to see kind of the rise of these buy now, pay later programs, people getting further and further into credit card debt, those type of issues. That's all kind of asymmetric of a consumer that's starting to kind of reach their limits, at least in the short term. And again, doesn't necessarily mean a recession, but it does suggest slower economic growth, which in and of itself is disinflationary historically. So let's flip over, talk about what you need to know before the bell real quick. The market, again, rallied. Market kind of spent a lot of the day yesterday kind of flopping around. Finished up just barely positive yesterday, but put in another green candle in yesterday's activity. So again, this bullish rise, ever since we did this last check of the 100-day moving average, we crashed through the 20, crashed through the 50, have just kept on traveling higher here. Markets are back to overbought. We're still in that buy signal, so again, nothing to worry about. Expect a correction here in the next few days. Now again, not a 10% correction, I'm not talking about another April type event, but expect a little bit of a pullback here, retest that 50-day moving average. That would actually be a healthy process in the markets right now. But again, just something to alleviate some of this overbought condition in the next few days. Again, that could be the CPI report tomorrow comes in a little bit hotter than expected. That would certainly cause markets to kind of sell off here a bit. And there's a risk, by the way, in the data that because of the lag effect in the data that CPI report may be a little bit hotter than expected. So again, while most of Wall Street is expecting a cooler print, there is not a zero chance of a hotter than expected print. So something in line at 0.4, maybe even a 0.5 print, that would certainly put pressure on the markets tomorrow. So again, there's certainly some risk there, so be aware of that. On the bond side as well, interest rates have been kind of coming down here. We kind of peaked recently, have been selling off. So again, we peaked in last October, November, sold off. Interest rates kind of rallied back from a deeply overbought condition. Now they've gotten, kind of working back down, sitting on kind of support here. Again, a weaker than expected CPI print tomorrow is going to kind of fuel a potential push for interest rates to go lower, bond prices to go higher. Remember, this is an inverted chart, so this is interest rates, again, on a sell signal here, which suggests lower rates, higher bond prices. But again, there's a good bit of resistance right here. So where you've got the 50-day sitting right below where interest rates are right now. So again, if we can get through those moving averages, then interest rates can certainly go lower from here. But again, maybe a little bit too soon for that. We'll see what happens again tomorrow. These inflation reports are going to have a lot to do with the bond market, a lot to do with the stock market tomorrow in particular, because of just kind of all eyes on really the Fed, rate cuts, what they're going to do next. Anything that deters that is certainly going to, kind of put the kibosh on the recent bullish rally that we've had over the last few days. But again, that doesn't mean a huge correction, but again, kind of working off some of this overbought condition would not be surprising at all. So again, that's what you need to know before the bell this morning. When we come back from the break, I want to talk a little bit about the markets. And again, we'll talk about this, but it's easy to kind of get wrapped up into headlines and narratives and those type of things. And there's certainly a lot of economic data out there that is certainly worrisome. But can the market give us a better clue as to what is going on with that data and where it may potentially lead us? So we'll talk about that when we come back. That's part of today's article that's on the website right now at realinvestmentadvice.com. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, But are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. John Penn joining me. Got a few things to talk about this morning, but I wanted to start with this real quick. I wanted to show you a couple of things in today's article that is on the website right now, realinvestmentadvice.com. I'm going to put this chart up on the screen. I'm going to get John to take a look at it because he hasn't seen it yet. But this is a chart of the S&P 500 with some interesting blue dots. Now, I just want you to pay attention to those blue dots for a moment because they're very important to a lot of the themes that we hear about, right? So again, lots of economic headlines out there about bad economic data. Lots of people like the dollar's going to crash, all this type of stuff. Just pick your theme du jour, right? Plenty of them running around, plenty of things to worry about, be concerned about. But pay attention to those blue dots for a moment because this is what's important. And again, there's as we are managing our portfolio, lots of reasons to be skeptical about the markets. I certainly understand that. I'm skeptical of them too a lot of times. But, I got an email this morning is like, this is all fake money in the markets, right? If everybody decided to sell at once, the value would be zero. And that's a true statement, right? Because you have to have buyers and sellers. So if everyone magically decided to sell tomorrow, the value of the stock market would be zero, right? So that's just the way it would work. But that's not very realistic, right? But there's certainly, things to be concerned about, but it doesn't mean that we don't want to participate. But so this is important, those blue dots. Keep that in mind. We're going to come back to this chart in a second. Now, when you start, so in 2022, everybody expected a recession, right? Now nobody expects a recession. I'm going to show you this table. This is a table of GDP going back to 1956. And the reason I have to go back to 1956 is prior to 1956, the National Bureau of Economic Research did not date recessions, right? So we didn't have official dating of recessions. But what you'll notice is that in the month or two prior to the onset of recession, GDP, except for one case, 1980, they were coincident. But in every case, the GDP was roughly around 2% growth, right? We're about 1.6. And so the month or the quarter before we actually went into a recession, officially, we had positive economic growth and roughly about 2% growth. So 1.6% now, and everybody's like, oh, yeah, no chance of a recession whatsoever. But that's the problem with the data, right? We've got to go back. We have to revise the data. So at the time, we don't know these things. So now I'm going to bring back that chart that I was showing you a second ago with those interesting blue dots. And I'm going to put some interesting yellow triangles on here. And this is your shape test this morning.
I'm all about focus.
There you go. Focus, John.
I'm here.
So here's the important part. The market already was declining 6 to 9 months prior to the National Bureau of Economic Research coming out saying, oh, we're in a recession. And then they would backdate the recession, right? The point, though, is that the market leads economics by 6 to 9 months. Now, look, we're all sitting around. We all want to be armchair quarterbacks, right? I'm not going to invest right now because there's a recession coming. I can feel it in my bones, right? Maybe it's the case. But you have to remember one thing about the stock market is that it is a massive group of people, right? It's me, it's John, it's you, it's everybody in our chat, it's everybody in every major Wall Street firm, finance company, bank, everywhere else in the world, right? Every economist. The market's made up of millions upon millions upon millions of minds that are all analyzing and focusing on the same set of data. And that translates into price. So while you may disagree with what's going on in the markets currently, that's fine. But what the markets are telling you may be something different. Let me show you this. So every week in our Real Investment, so we have our Bull Bear Report that comes out every Saturday. So you subscribe to it. It's free. Just go to the website, realinvestmentadvice.com, click on the Bull Bear Report, put your email address in. We'll email it to you on Saturdays. In that newsletter every Saturday is this table, and it's our risk range report. Sorry. And what it shows you is the risk ranges for major markets and major sectors for every month. And so as we progress through the month, it tells you whether or not a sector is outside of bounds of its normal trading range. And if it is, you're probably either going to get a rally or a correction. And so it's just a good way to kind of manage short-term risk. The far right column is the most important. The far right column is the short and long-term moving average crossover indicator. And that's a weekly indicator that gives you a better indication of the overall trend of the market. Is the market bullish or bearish? Right now, every sector is bullish except for the dollar. That's bonds, that's gold, it's stocks. Everything is bullish right now. And now this is important because in October of 2022, actually in January of 2022, we had a sell signal that said in that risk range report, be cautious. And if we take a look at the S&P 500 as a good example here, if I use that same indicator and I chart it, the shaded areas are when the risk range report said you need to sell and be out of stocks. And then when there's no shaded bar, that's when you're supposed to be in stocks, right? Because they're on bullish buy signals at that point. Now, with the exception of 2020, where the downturn was so fast and so rapid, again, these are weekly indicators, so it takes a few weeks for them to catch up. So you're never going to ping the exact top. You're never going to ping the exact bottom. But it will get you out of the market early enough and back in the market early enough to avoid that big risk, right? Except for 2020, because that downturn, you had the 35% correction in March, and then back in April, you were back in a bull market in a month, right? So the signal didn't work well in 2020 because it was so fast. But outside of that, it's kept you on the right side of the trade more often than not. And again, let's go back and look at October of 2022, right? So this is the depth of the market. Everybody's negative. And again, every major sell signal was registered at that time. So it says, hey, look, be very cautious here. And at that time, we were extremely negative on views. I mean, everybody was extremely bearish all across the market. Now, when you have extreme bearishness on sell signals, that tends to denote a bottom in the market, right? So that was a good time to start putting money to work. And as the market began to recover, those sell signals became buy signals again. Now, these buy signals, as you saw in that chart previously, can last a while. And again, so if we take a look at this weekend's risk range report, what we see is that we have every major market and sector on a buy signal right now on a weekly basis, except the dollar. And these buy signals will last for a while. So again, while it may be, psychologically concerning about what's going on in the markets right now, or the economy right now, right? Inflation and all these things that we talk about, the risk of recession, et cetera. And there's certainly a risk out there. And this doesn't mean that this is going to be bullish for the next 10 years, right? But for right now, the market is not indicating, these millions and millions of minds are not indicating that there's any risk of recession on the horizon. Now, that will change. And when it changes and these become sell signals, it'll be time to get out of the market. But until then, we want to participate. So again, the whole purpose of all this data that we put in the weekly newsletters to help you make those kind of better decisions about managing your money so we don't get so tied up into headline risk and look, plenty of YouTube videos out there with, the end of the world, doom and gloom headlines, et cetera, enough to scare the bejeebers out of you and get you to go sit in cash. And that's okay, right? I can sit in cash right now and get 5%. Okay, great. Market's up 10 this year. And that's just through May. So annualized out, that's a 25% return right now. 25% versus 5, right? Yeah, I can be at 5, but if I get an extra 10 or 15 to my returns in a year, in the market, that's great. That just gets me closer to my goals sooner. And that's our job. Our job is nothing else. Our job is to make money. That's all it is. And so hopefully the reason I wrote this article is to kind of introduce you to that risk range report so you can look at it in the weekly newsletter every week and just try to keep, headline risk kind of set aside from what's actually going on in the markets. Because again, let the market do its job of being a predictive indicator of economic downturns, et cetera. John, your view?
Yeah, so many great points through there, Lance. It's amazing how, again, just our emotions can swing as investors. And we all visit with a lot of folks throughout the week and talk with a lot of folks, and it's still amazing to me how folks can have the best laid out financial plans, and we know what their hurdle rates are. We know the rate of return that they need to earn over time for all their goals to be successful. And, sometimes, hey, we're just wired as humans to let narratives and fear, greed affect our investment decisions. I mean, just look at what's going on in the markets here for the last 24 hours with the meme stocks again.
Exactly.
I'm like, really?
Yeah,
right?
Exactly. When we come back from the break, speaking about that, John had a great email from one of our clients. I think this is probably a common question that a lot of people have. And so when we come back, we'll talk a little bit about this particular question from this client and why we don't own something in particular in our portfolios right now. All right, be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I complain about inflation at my house all the time. I yell at my wife. I don't really yell at her. I don't really say anything because she'll yell back at me. But in my mind, I'm yelling about how much stuff is costing, and then I just go on about my business.
The Real Investment Show podcast.
Mike understands this. He's the same way. Mike and I have a lot of arguments in our head that never leave into verbal space with our wives.
At realinvestmentadvice.com.
She scares me.
Hey, mine too. It's okay.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So, John Penn just back from his French tour. So he went over to the wine country and, just wanted to check a few things out. Did you have fun?
I did have a good time. Thanks. Yeah, our youngest daughter was over there studying abroad this semester.
Mm-hmm.
So,
which abroad did she study?
Well, yeah,
that Mona Lisa.
The Mona Lisa. So she was in Strasbourg, France.
Yeah,
just right there next to the German border. At EM Strasbourg studying business, but we went over there, spent about a week with her, brought her home, and now it's back to school in Houston.
Yep.
So
were you glad to get back to Houston?
Yes.
Have some American food?
Good. I was just craving just an American cup of coffee. Just keep it simple. For some reason, the coffee over there just didn't taste right to me. I just needed a good American cup of coffee.
We were talking about yesterday on the show, the new study is out that you should drink 4 cups of coffee a day.
Should I do that before noon?
Well, but hang on a second.
Do I need to pace myself?
You need to pace yourself because the sweet spot is 4 cups. Now, if you go over, you get over 6, you start doing damage to yourself. So, but that 4 cups was sweet spot for maintaining muscle mass when you're older and reducing dementia. So we have to listen to yesterday's show because we covered all that.
Very good. Well, I'll be sure to pace myself and I'll spread that out. I'll have 2 cups in the morning and I'll have 2 cups in the afternoon.
There
How
you
about
go.
that?
There you go. So you got an email from a client yesterday.
Did. Yeah. Great question. Just about, talking about the markets and having exposure to equities. The question, Lance, was, hey, do we have any international investments in the portfolio right now? And when he was talking about international investments, not meaning U.S. companies that earn revenue from overseas, like multinational businesses like ExxonMobil, as an example. but do we have any direct exposure to the international or the emerging markets or any emerging market countries? So, Lance, what do we have any exposure there? And
we don't.
And your thoughts around that?
We don't, and we probably won't.
Why not?
Because let me just show you one chart here.
All right.
One chart kind of says it all. Actually, there's a couple of reasons, but this chart will show you. So this chart goes back to 2011. All right. So this is basically the entirety of the bull market run since the financial crisis. Right. And just starting in order of worst to best, right? So let's go to the worst performer over the last 14 years, right? China. Mm-hmm. Okay, so if you invested in China 14 years ago, you've made a 2% rate of return, right? So moving up the ladder, then the next worst thing is emerging markets. So emerging markets are up 46% since over the last decade. So it's about a 4.5% rate of return, actually about 3% rate of return over that period of time. Internet, and so if we kind of move up from there, that gold line, that's actually gold. So gold has been a terrible performer over the last decade versus other assets, right? So again, let's go back to our previous commentary. What's our job? Our job is to make money. That's what our job is. And so I want to invest in things that are going to have the best potential to grow wealth, right? And so if you take a look at emerging markets, they're dependent on the U.S. and they're dependent on other international countries to sell their product too. So if Europe slows down or if the U.S. slows down, they sell less product because they're exporters, not importers. We import, right? So, and of course, there's other things that go on with these countries as well, Brazil, Argentina, et cetera. They have all kinds of their own internal political, geopolitical, economic problems, et cetera. So again, where do I want to invest assets? And I want to invest assets that have potential to grow. So if we kind of keep moving up the ladder, we get into industrialized international stocks, which have had about 142% rate of return over the last 14 years, right? When we get into the U.S., the S&P is up 359% of that same period of time. The NASDAQ is up 973% in that time frame. Mm-hmm. So where was the best place to put money? Now look, you can have all your theses, right? About, well, the dollar this or that, or economic this or geopolitical that, whatever. That's fine, right? But our job's to make money. So where's the best place to be invested with your capital to grow it over time? And so are you better off having a lot of money so let's take it one step further, right? And let's talk about diversification, right? So what does everybody do? John, you have plenty of clients, and when you sit down with a client review and they say, how did we do last year? Yep. What are they comparing to?
They always compare themselves to the Standard & Poor's 500 index. Right. It's like 99% of the time.
Yep.
Right?
Because that's what everybody sees.
Because that's what everybody sees. And we've been trained from the financial media to think that way.
That's right. Mm-hmm. And so they go, how did we do versus the index was up 10 last year. How did I do?
Yep.
Right. Okay. So if you owned a diversified, and this is also where Harry Markowitz, 1974, modern portfolio theory, you just owned a basket of diversified investments, right? So international, emerging markets, some gold, U.S. stocks, real estate, small cap, mid cap. Oh, let's talk about small cap, mid cap real quick. Small cap over that time frame is up 146%, barely better than the international markets. And mid cap is actually very close to the S&P. So the mid cap has actually done very close to the performance of the S&P. So that's the one other asset. But importantly, the thing is that if I run a diversified portfolio and I have a whole bunch of lagging assets in there, right, I'm not going to perform anywhere close to the S&P 500, right? So if I'm comparing myself to the Formula One race car, which is what we all do, I can't have these other assets. Right. So why don't we own emerging markets and international stocks is because it would provide too much drag to the portfolio relative to what's going on with the S&P. Now, will that change someday? Sure, absolutely. Don't know when. And if it does, we'll migrate our portfolio. But right now, there's nothing indicating that those are assets that we want to own longer term.
Well, is it? And I know that the U.S. dollar's been weakening, but it's still relatively strong.
Well, no, it's actually not been weakening that much. It's had a little bit of sell-off here lately. But remember this time last year, John, we were hearing the death of the dollar.
Oh, yeah.
And Mike and I wrote a series of articles about how the dollar's not going to die. And so we've had this huge rally. And that's why central banks have been buying gold, which has been to hedge off reserve currency risk because of the dollar getting too strong. And that's what's been happening. So that'll reverse, at some point here, and the dollar will weaken as it will do, as any asset class will do over time. And so we'll get there.
So in thinking about this a little bit further, then the higher interest rates that the Fed has put into place has made the U.S. markets more attractive, right?
Absolutely.
So there's a lot more fund flows coming into the U.S., which in line supports the U.S. markets, right?
Yeah. Your foreign inflow. Well, it's not really the Fed so much; it's that the raging asset run in the U.S. Is dragged. Remember, investors all around the world, they're looking for the best rate of return too, and they're looking at their country versus the U.S. and going, do I want money in my country or do I want money in the U.S.? And so AI and all this other stuff that's going on in the U.S. is dragging foreign inflows into the U.S., which is propelling the lift of the asset prices here in the U.S. because you just have extra buying power, right?
Yep. So even though we don't have exposure to the international or the emerging markets now, that doesn't mean that we won't at some point.
Right.
It's just that we don't really want to have that exposure in the portfolio currently.
Right. Not when it's basic. Think about it this way. You've got a speedboat, and you want to go across the lake really fast, and then you throw a bunch of anchors behind the boat.
Yeah.
Right. That's all you're doing by adding these other asset classes that are going to subtract from your performance. And again, so that's why we have all different types of portfolio structures based on conservative views, et cetera. But again, if you're trying to beat the S&P, you have to own, and you're not going to beat the S&P if you're trying to beat the S&P, but you can match the S&P by just owning the S&P.
Yeah, so if I'm in like a 20% equity, 80% bond portfolio, what I'm hearing is I really shouldn't be comparing my returns to that of the Standard & Poor's 500 index, right? That's not an apples to apples comparison.
That's correct. And again, but this is also important to separate, what we think from what we want. And, I hear a lot, I've met with a lot of people in my life where they say, oh, I'm ultra conservative. I don't want to lose any money. Okay, great. So we can build a portfolio that basically won't lose any money. That's fine. And then the market goes up 20%. Well, why didn't we make 20%? Because you're in an ultra conservative portfolio that won't lose any money. You can't have both. And, we had this conversation. So this is Friday's article on the website, by the way, is talking specifically about that, which is you can only have 2 of 3 factors in any investment. So if you want safety and liquidity, you have to give up return. If you want return and liquidity, you've got to give up safety. You have to give up something. You just have to choose what you want to give up.
Yeah, and so in the previous segment when you were walking through your article that's on our website on realinvestmentadvice.com, you were making a lot of great points about, choosing periods of time where maybe you're in or out of the market, right? And that's not an all or none decision. It doesn't need to be an all or none decision. It's not like we're ever all in or ever all out. But as markets grow and have strength, you can use that to your advantage to trim and take profits, right?
That's right.
And as markets pull back, you can use that as an opportunity to nibble, right?
That's
and
right.
just gain some additional exposure. And that's just about being proactive with managing risk over time. You're not going to get all of the upside, right? But we still want our clients to be able to participate. We want their money to grow and support their objectives and everything that they want to accomplish, right? But it doesn't need to be an all or none decision.
That's right.
Right.
That's right. So again, these are just all kinds of just considerations. Again, how you manage your own money, that's up to you. You do what you feel is right for you. Make your own thesis, make your own bets, and that's what investing is all about. That's the great thing about financial markets is that you can have your own thesis, make your own bets, do whatever you want to do, and you can create your rate of return that way. It's just the point though for us in terms of managing money, because again it's different, right? You can do whatever you want with your portfolio. For us, in order for us to do our job, we have to meet our clients' expectations, and that can sometimes be a bit challenging. So,
to put it nicely.
All right, quick break. We're going to come back, get ready to wrap up the show with John Penn this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right. Get ready to kind of wrap up the show this morning. So economic data today is the NFIB Small Business Report for April. That's been showing some, very concerning data as of late. And again, I'm anxious to kind of see that report today because it's actually, that's a good lead indicator for hiring. And what we've seen in that report in particular is a trend of small and mid-sized businesses, which make up 50% of the employment in the U.S., shutting off job openings, right? We keep hearing these reports of these elevated job openings. We have, 2 job openings for every person that wants a job, right? So why do we have, kind of other employment issues going on? But job openings are declining for small to mid-sized business. In other words, they're starting to pull those off, and their expectations to hire have been declining. So it'll be interesting to see if there's any change in that data, if there's any improvement whatsoever. Because again, small businesses make up about 50% of all businesses in the U.S. They make up about 50% of the hiring. And the vast majority of those businesses, about 70% of them, have less than 10 employees. So again, this is your, local donut shop, your local little restaurant on the corner, the local hair salon. Those are those businesses that are solely dependent on you as a consumer. And again, the best thing that you can do for the economy is to not shop at Amazon and go shop at your local retailer, right? Help those guys out because, that's what keeps the economy functioning is those people, right? So go help them out, shop local, and you'll do the economy a favor.
Yeah, there are a number of folks that we work with that are small business owners, and I would say of all of the individuals and family groups that I am visiting with as of late, Lance, it seems that those that are small business owners, they are most concerned with really controlling their overhead, and they're watching their expenses moving forward. Mm-hmm. And there's been a lot of folks as of late saying, they would like to hire some more employees, but they're just not quite ready to pull the trigger on it yet.
Yep.
So they're just kind of buckling down the hatches a little bit here to be on the safe side, at least in the near term.
Yeah, and I think that's what we're seeing from even small businesses like restaurants and things where so it's interesting. My son's home from college for the summer. after a severe round of physics, in chemistry, he tends to load up on classes, right? Physics, chemistry, everything all at once. He kind of just needs a little break this summer, so he's home looking for a job. And normally he can get a waiter's job super fast, and he's having a little bit of trouble finding a job right now. He's only been home for a couple of days, but normally he can have a job waiting tables within a day or so, and that's not the case right now.
Yeah.
So. But again, I think we are starting to see that a little bit. Earnings data out today. I said producer price index was out on Thursday. It's out today. It comes out today before CPI. So my apologies. Producer price index is out today. That's expected to be 0.3 versus 0.2 last month. And then earnings today are Alibaba, Home Depot, Rumble, Sony. We're through, again, as I said before, we're through most of the major companies. We've still got a few kind of stragglers that are coming in. NVIDIA will be towards the end of this month. That's the one everybody's watching closely because of the whole AI thing. And then tomorrow you've got Cisco. So there's a few kind of big companies left, but again, we're through the bulk of earnings season at this point. So that's really starting to cool down. Buyback windows are back open, so companies are buying back stock now. Interesting. There's, we talking about the consumer, John, one of the things that we're starting to see, and we really need to figure out a way to pass a law to stop this, but people are taking a lot more money out of their 401k plans. We talked a little bit about this yesterday. I posted a chart on Twitter that you're seeing a lot more people starting to tap in, both just taking outright withdrawals from their 401k, paying the taxes and the penalty, but also taking loans out of their 401k.
Yeah, and the 401k plans, they tend to be a place where folks can accumulate money. Because it's kind of a set and forget, right? So they set up that automatic deferral, and so they've got that money building up in there, and all of a sudden they go, oh, hey, I could use this to pay off some credit card debt, right? Or I could use this to pay off some loans, whatever that may be. And it seems that the rules for accessing retirement plans are pretty lax, right? And it's really, at the end of the day, are we really doing the right thing by allowing folks to have, I get it. It's your money, right? And I get that. It's your money. It's your hard-earned money. You're putting it aside and you're building up those accounts, and it's for your future, endeavors. It's for your retirement. But it's pretty easy to get in there and start pulling out money. Then all of a sudden you have to start all over again, right?
Well, and again, one of the misnomers on this is, I'll just take out a loan. I'm just borrowing from myself.
Yeah, I'm just going to pay myself back, right?
And the problem with that is you're taking money out that's pre-tax, and then you're paying yourself back with post-tax money. So the interest rate on that is as astronomically high when you do that. And you're setting yourself back, because when you borrow that loan out, that's a negative against your balance. So your balance isn't growing as fast as it would otherwise. So, look, I know things get tough at home, and there's certainly reasons why you have to do it. But, my gosh, just try. That's got to be the last possible resort, not the first opportunity.
Yeah, I agree. Or if you can, maybe just back off on your contributions. Don't pull money out, but maybe just kind of back off or pull your contribution amount back a little bit, just to give you a little bit of extra cash flow coming in at home if you need that in the near term. What I tend to find is this: there's a behavioral loop that gets set up. Is, well, I'm just going to borrow from my 401k plan just this once, Lance.
Yeah,
just this once.
And it's so easy.
And it's so easy. Well, I'll pay it back.
Yeah,
I'll pay it back. Then all of a sudden, maybe you switch jobs or you switch employers, and now it's time to move that plan to your new employer's plan. Well, guess what? You got that outstanding loan that you got to pay off first.
Right.
And so that really hits your pocket, right? But then, well, I'll pay it back. So, okay, let's say you do. Let's say you take the loan out of the 401k and you pay it back. Well, you know what? That wasn't too bad last time. I'm going to do it again. And it happens again and again. And it can just be this repetitive, issue that you deal with, and that can just really hurt you in the long run, right?
Yeah, and again, these are these small financial decisions that have really major impacts on, financial net worth at the end. And I find it very interesting. There's a lot of backlash against the wealthy right now. It's like, there's this massive wealth. There's tons of articles about how upset Gen Z and millennials are about, the boomers having all the money, et cetera. We got to remember, boomers have had a very long time to save and invest money. And they didn't have a lot of the stuff that is draining your accounts. They didn't have that, right? They didn't have cell phones. They didn't have cable bills. They didn't have all this other stuff that we today think we have to have, right? We have to have cable. No, you don't have to have cable, right? You don't have to have internet. These are nice, but are they required for your survival? The answer is no, right? But they didn't have that at all back in the 60s and the 70s. So they were saving money and they were investing in the market. And they've had decades to allow those assets to grow. So that's why they have a lot of wealth. The millennials just haven't had time to get there yet. But there's also all these other drains that we have on life, right? We have all these other things that we have to have, $1,000 iPhones and whatever, that continues to set us back in terms of saving and investing our capital.
And they actually had to get up and go to the store if they wanted to buy something.
Yeah.
What a novel concept. I mean, honestly, you could sit there at home today and point and click and have everything. You don't ever have to leave the house.
Yeah.
Unless there's some major medical emergency,
yeah.
right?
We were actually talking about that the other day, is that, when I was growing up with my dad did not have a credit card,
yeah,
right? And he hated checkbooks. So he paid for everything in cash. And that was the way I was raised, is to you pay for it in cash. And, and we were talking about Dave Ramsey, who has the envelope system. Mm-hmm. And it's a great way to really kind of rein in spending, because when you've got to actually go spend cash in the store, you feel what you're spending on. And it makes it a lot easier when you're making purchase decisions to say, I really don't need that.
Yeah.
It's so easy when you're just throwing it in your basket and you go up there and you just rip a debit card through there and it's all magical money anyway. But when you're spending cash, if you really want to get a handle on your spending, spend on cash for about a month and you'll figure out exactly how much leakage you have in your overall net worth. And that's where you can actually start building some real assets.
Well, look, there's a couple that I work with where many years ago they used that envelope system mm-hmm. to get themselves out of debt. And they paid for everything in cash, no matter what it was. No debt. But they had debt that they paid off using that envelope system. But they went so extreme that their diet, what they ate, and I forget how long this period of time went for, but all they ate was red beans and rice.
Yep.
That's it. Just to control every single cost that they could, just to get themselves in a better position. And now they're much better off for it. But it took a serious amount of discipline for them to do it, right?
Yeah, no, absolutely.
From a mental standpoint.
Absolutely. Real quick, Larry says you pay taxes on money from a 401k loan after you pay it off. You don't have to pay taxes on that again. That's not true. When you take out a loan, it's a loan from your 401k plan. You pay it back with after-tax dollars. It is then a tax-deferred asset in your account, and then you pay taxes on the total amount when you take it out of your 401k plan in the future. So now, if you take just a withdrawal from your 401k, you pay a 10% penalty and taxes at that point, but then it's out of your 401k plan. You don't have to pay it back.
Yeah, right? and now now that Roth 401ks are becoming more prevalent, we are seeing more people able to use a Roth 401k.
Yep.
Your money or your contributions that go into the Roth, your contributions can come out, but and you're not going to pay tax on that. But to your point, depending on your age, you could have a 10% early withdrawal penalty on that too. So you got to watch that.
Yeah, and at my age, it's always an early withdrawal penalty because I'm hanging in there at 39, baby.
That's it,
so
man. You look good for 39.
There you go. Thank you. Appreciate that. Yeah, I was actually thinking the other day, it's like I'm almost ready. I can get Social Security here pretty soon. I still get the AARP cards. Throw those away. Not ready for that yet.
No, sir.
All right, wraps up the show today. Be back tomorrow. Danny Ratliff. Catch up with the markets today. We'll talk about PPI tomorrow, what happened, NFIB as well. Get you up to date. Have a great day. See you tomorrow.